In today's episode, I'm going to answer the question, where else can you invest your money? I'm going to give you a few things to consider as you expand your investments, and then I'm going to offer you a resource that will help you along the way. Stick around because we're going to cover the ways to help you ignite financial freedom. All right. Welcome to episode 25. Ooh, big 25. Welcome to episode 25 of the Igniting Financial Freedom podcast. Today, I am answering the question, where else can you invest your money? So for those of you listening at home or in the car or on your run or working out, beautiful mug right now somewhere live on Facebook or on YouTube. As with the last probably 5 episodes, I give a disclaimer basically stating that I'm not an accountant. I'm no longer acting in the capacity as a financial advisor, although when I speak with coaching clients, I'm certainly giving them my perspective and my 2 cents and what I would do in their shoes. But that basically means that I'm still not necessarily going to tell them, go to this company or go to this account, open this account, buy this particular fund or buy that particular stock or invest in that particular whatever, crypto, right? So take that with a grain of salt. But even still, today we're going to talk about where else you can invest your money. So there is a few options I want to cover, 3 options in particular. This is by no means an exhaustive list. And with the last several episodes, I want to cover some parameters that I would love to see in place before you consider these alternative investments. Number 1 being a 2% mini emergency fund built. So you've got an $80,000 family income. That means $1,600 sitting in cash, not attached to your checking account for overdraft protection, not at your main bank, not attached to a debit card or an ATM card, separate. The bank down the street, the credit union down the street, the little local bank that you have access to, but you have to drive there, or you have online banking and it takes 2-3 days to move it back to your main bank, right? Second, you've paid off your bad debt. Anything with an interest rate of 8% or higher, or something that's not attached to an asset, credit cards, student loans. Again, I've talked about that. There's a gray area there. Cars, depreciating asset, not the best thing in the world, but at least the interest rate's likely going to be less than 8%. So we'll kind of give those a pass. And you also have a definitive plan and an automation plan set up for funding your 3-month emergency fund and funding your sinking funds. Go back through previous episodes. I talk more about sinking funds in particular, but you've got some kind of automation every paycheck where it's $100 to my emergency fund and let's say $300 into my sinking funds. And it just comes off the top every paycheck. And then you work with the rest. If your paycheck was $2,000 twice a month, now you're working with $1,600 because those need to become a priority. You're paying yourself first, and then you're working with the rest. And then finally, what I'd like to see for the 4th condition or assumption of before we're moving on to alternative investments would be a minimum of 10% funded toward your long-term retirement. That's in your more traditional style buckets. That's in your 401k. Hopefully you're getting a match from your employer, and then maybe it's pursuing a Roth IRA and funding that. Maybe going back to the 401k if you need to supplement the amounts that you're going to be saving. 10% is a great number. 15% is even better. Somewhere in that 10 to 15% range of funding that long-term bucket. From there, you can then consider branching out and moving into alternatives. I don't even like to necessarily use the word alternative because some of that, can be construed as speculative or high risk. And now some of these suggestions I'm going to bring up are definitely on the higher risk end of the spectrum. But number 1, I'm starting with the best one, starting with my favorite one as an alternative to just your traditional index mutual funds, target date funds, kind of your plain vanilla type stuff. Number 1, and by far my favorite, is investment real estate. So I'm going to go through 7 examples of what you could consider as an alternative within the investment real estate world. And please take those, again, with some degree of caution and some degree of reserve when you approach this. Investment real estate is a very attractive game. A vast majority of millionaires and wealthy people, in particular in this country, invest in investment real estate, but they do so with a bit of, I don't know the right word, maybe tact. So they're not just going in blindly and buying a complete junker house and trying to flip it the first time. Maybe they've partnered with a mentor or they've got some cash that they need to bring to the table. See, with investment real estate, it's generally you either have the expertise or you have cash. to bring to the table. One of the two. So most of the times, if you're a beginner investor, you've got to bring something to the table, and you don't have experience because you've never done this. So you're bringing some cash to the table, or you're bringing a combination of cash and sweat equity, meaning you're willing to swing a hammer and rip up carpets and refinish hardwood floors and knock down some walls and figure out how to put up drywall and replace plumbing and electrical and whatever you might want to do. And if you're not willing to do that, you at least have the cash to do so. Okay, so one piece of advice in terms of just off the top with investment real estate, pursue local investment clubs or groups. When I was more active in investment real estate, in particular in a subset of investment real estate called wholesaling, I won't go into that on this episode, but I leveraged local contacts and local real estate groups, REIA, Real Estate Investment Associations, or REIA, for making those contacts. And investment real estate is all about relationships, and that's who you know. Okay, so you've got to leverage those early and often. And if you can't find an investment real estate meeting close to you, then create your own and put it on Meetup, put it on Facebook, create a group there and establish that. I have a friend of mine in my town here who didn't have a group directly in my town. His is focused on multifamily. He knows who he is. I'm shouting out to him. He created his own Meetup, and it's an amazing group now. 3 years ago when he started it, it was, 5 people showing up at the local coffee shop or at the local brewery. But now it's mushroomed into this amazing group. So anyways, okay, back to the investment real estate. The number one, probably the best way to start, I would say, is your kind of your intro level would be what's called a house hack. This has become a very popular buzzword lately, coined and made famous by Brandon Turner from Bigger Pockets. I'll go into that later. But house hack would simply mean you have a 3-bedroom house or a 4-bedroom house, and you're willing to rent out 1 or 2 of the rooms since you're not using them. And honestly, that's about it. The beautiful thing behind it is, let's say you have a $150,000 mortgage on your house, and it probably runs you $800 a month. I'm totally guessing. I have no idea. $800 a month, $900 a month for the mortgage. If you're willing to rent out 1 of your rooms or 2 of your rooms at $300, $400, $500, $600 a month, you could cover most or all of your mortgage payment. And now you're living for free. And that $800 or $900 mortgage payment that was once going out the door every month to mortgage company XYZ now can go and fill your bucket that you're now going to be reinvesting into real estate. So one of the 2 people sorry, I thought my computer just shut off there. One of the 2 people. So like for me, it was hard. It was a hard sell for my wife to have somebody living in our house. So we didn't end up doing that. It might not be for everybody, right? To have somebody in the room next to you that you may or may not know. So that's something that you have to talk out. The next one would be what's called a live-in flip. There's a lot of people on Bigger Pockets, that site that I mentioned at the end of the podcast here, that made that method of investing popular as well. And basically, you buy a house that is pretty rundown, and you invest in that house, knowing that you're buying it at a discount. You live there for at least 2 years, with the idea that you're going to renovate it and build it and rehab it while you're living there. And then in a 2-year time frame or longer, you sell the property. You don't pay any tax on it because it's considered a owner-occupied transaction at that point, as opposed to flipping a house within, let's say, a 3-month or a 6-month time frame. You're going to pay capital gains tax on that. But the live and flip is more so for those that are handy, more so for those that are willing to kind of live in a chaotic environment with, busted down walls and plumbing that's turned off and kitchen that might be torn up and bathrooms that might be torn up and so on. So that's not for everybody, but it could be a good fit depending on what you're looking for. The third option would be another type of house hack, but instead of renting out individual rooms, you might buy a 2-unit property or a 3 or 4 unit property. From a lending standpoint, it's still considered a residential loan. So that's probably a little more, what's the word I'm looking for? Like, it's more of it's a cleaner like setup, because you're living in one unit and you've got a tenant next door, and they're hopefully offsetting most or all of your principal and interest payment on your mortgage and maybe some of your taxes and insurance. So you might not be living for free, but you're going to be covering a good chunk of your expenses that way. And then again, the money that you would normally be putting towards that should not just fly out the window. It should be either reinvested or at least put into a savings account until you have another big chunk of money that you can then buy another property, and so on. And the snowball continues. Right. So just like the debt snowball or the debt avalanche or any of these other debt payoff strategies where you pay off your smallest credit card first, you pay off the card with the highest interest rate first, you take that minimum monthly payment and you roll that into the next debt. Well, the same principle here applies. You're going to take the payment that you would have otherwise been paying, right? It works in the same direction. It works in the same principle, but it's instead of paying the next credit card, you're continuing to pay yourself. Again, rather than that money just going to restaurants or going to Amazon or going to Target, that $800-900 that your mortgage payment is now, that you're no longer paying because of your tenant, you're reinvesting that into a savings account, then you're paying yourself. And then that's how you significantly change your trajectory for building wealth, right? Okay, so that's house hack, 2 to 4 unit house hack. The other one is just flipping a single family house. So not living in it, but maybe there's a neighborhood around your house that you know well, and you know the style of house, you know the market for those houses, and you have an idea of, you know, what they're going for. And if you can find one that's probably close to half off, 50, 60 cents on the dollar, you could buy it. So the general rule, don't hold me to this, right? Take this with a grain of salt, but the general rule was you find a house that's distressed, that's been beat up. Maybe it's a foreclosure. Maybe the owner got into some tough times and they weren't able to pay their taxes, pay their mortgage, whatever, and they foreclosed on the house, okay? Or it's a tax lien on the property and owner had to go. You buy a house like that, that's, again, 50 cents on the dollar, 60 cents on the dollar, with the idea that if it's all fixed up and ready to go and ready to sell for $200,000, and you can get it for $100,000, which is, again, 50 cents on the dollar, and you can put, you know, about 20 cents on the dollar into it. So in that case, about 40,000. So you're all in with purchase and your rehab for 140. You make a nice profit on that. That 30% margin, that 60,000 in this case, gives you enough wiggle room and enough margin for error with your closing costs and your realtor costs and everything else that comes out of that to sell it for a profit. Okay, so that's just a single family flip. Okay. The other option is you could do what's called a BRRRR, which is a single family flip, but you hold the property. You don't sell it. You buy it distressed. You fix it up. You don't put quite as much money into it because you're not selling it retail. You're not selling it for trying to get top dollar out of it. You're rehabbing it. You're renovating it with the intent of just renting it out. So you don't have to put the nicest finishes and the nicest appliances and all the other, you know, super nice vinyl plank hardwood throughout and redone windows and window treatments and all that stuff. It still has to be a nice place, a livable place, but depending on the neighborhood, depending on the market and what kind of a tenant you're trying to attract, you might get away with a little bit lesser of expensive style of rehab. Okay, so that's the other one. That's called a BRRRR. That's also made popular by the guys at Bigger Pockets. So that's a buy, renovate, refinance, scratch that, buy, renovate, rent, refinance. The refinances, you've renovated the property, you've put a tenant in there, it's generating income, you've increased the value of the property. So your $100,000 property that you bought that's junker now is worth $200,000 or more. You can then refinance at a higher value and thus take out some more money from the equity of the property and then redo it and do it all over again. Continue to do that and build that snowball. Okay. A little bit more advanced strategy would be what's called a syndication. You could partner with multiple investors and pool your money together and buy something like an apartment complex or a strip mall or commercial property or a storage unit. There's a lot of avenues to go here, and maybe that was not the one that you want to take down first, but there's a lot to be said about just going right for the jugular and finding that, skipping a lot of those beginner steps and going right for it. There are also passive investments that you could consider within the world of investment real estate, and that might be just some companies that I wrote down. It's just one is called Fundrise. I'm not endorsed by any of these guys. I just did my own research. I've heard of them plenty of times, but Fundrise or CrowdStreet. You're basically pooling together money at a much lower scale into the same kind of principle of this syndication, whether it's apartment complexes or resorts or hotels or strip malls, commercial properties, storage units, things like that. So it's at a much lower scale in terms of what you need to put in to start, but it's still a great place to get your feet wet. Most of these investment real estate avenues are pretty illiquid, meaning that you're going to have money tied up here and it's pretty much not accessible except maybe for the flip. That can be turned still, though it's a 6-month time frame, maybe a little bit less if you're efficient with it. So this is a complement to your kind of, again, your bread and butter investment within your mutual funds, within your 401k, your Roth IRAs. This is a subset or a complement to that. The next one that I would consider my second favorite would be individual stocks. So individual stocks, of course, are more volatile and can have less predictability when buying them. Depending on the type you buy, of course, there can be a lot of fluctuation, and there can be even companies that go out of business. You might have a company that you are attached to for reasons more than just the financials of the company. So growing up in Dearborn, outside of Detroit, there's a lot of ties to Ford Motor Company. So I own some Ford Motor stock. Do I need to? No. Has it been performing? Sure. It's great. I like owning it, and I like keeping an eye on it. If you live in Phoenix, you probably have zero ties to Ford Motor Company. So you won't have anything that's compelling you to buy Ford. If you live in Omaha, which is where Warren Buffett's from, you might have a pull to buy Berkshire Hathaway stock. More power to you. It's a good company to own. I own some of that too. If you live in Atlanta and you have family that works for Coca-Cola, or you yourself work for Coca-Cola, or you also drink quite a bit of Coca-Cola, you might want to buy some Coca-Cola. I'm using non-number-based reasons. I get that. But there's something to be said about having a passion and having a conviction behind a company that you support and believe in. Same thing maybe for McDonald's, right? You eat McDonald's all the time, and it's still it is a good stock to own. Maybe that's a reason to start there. And it would give you the interest, and it would give you the idea to follow it and to keep up with it and to monitor it regularly so that you have an interest in it, and so that you spend the appropriate amount of time invested in these companies that you've decided to invest in. You could also consider stocks that pay a higher dividend. A dividend is basically a share in the profitability of a company. So they'll pay a certain percentage out, generally on a quarterly basis, of a certain percentage or dollar amount of your shares, how much you owe. Okay, so you might have a 2%, 3%, some companies as high as 8% dividend payout, meaning it's just a percentage of, again, how many shares you own. So that can begin to create some income for you so that you have some return that's coming to you every single quarter from these stocks that pay a nice dividend. You could also consider stocks that might fit into a certain sector. So you might work in the IT department at your company. You might work as a physician. You might work as, I don't know, an engineer. So you might want to tailor your investments to particular sectors. I worked in finance for a long time. I particularly like finance companies, banks in particular, because the fundamentals are there. The margins are generally pretty good, and banks are pretty, for the most part, pretty sustainable, right? At least some of the bigger ones. For tech, you might have a certain inclination towards Tesla or towards Apple or towards Google or towards Facebook. Maybe you work at one of those companies and you have a bias towards one of those. That's fine. That might be a good place to start. Keeping in mind, again, that all of these stocks that you buy are a complement to the overall picture. So far, we're only through the second bullet, but what I would recommend is that you're not putting too much into any one of these alternative buckets. I'll get more into that here after I go through a couple more examples. So, and then finally would be, again, just other sectors you might want to look at that might be cloud computing or investment in AI, or maybe some alternatives to, environments, right? Maybe you're not so keen on investing in oil and natural gas, but you may be more keen on investing in wind and solar, whatever. Okay. The point being, something that you have some conviction behind, something that will kind of get you excited about it with the intent of keeping you interested and then continuing to invest, because the whole point is to invest and to grow your assets and your wealth long term. Okay, number 3 is cryptocurrency. So this is a pretty hot topic right now. So there's a lot of speculation as to what crypto is going to turn into. I, for one, think that it is going to become a substantial and meaningful source of currency in the future. So my stance is that I don't have a particular favorite horse in the race. So I've just decided to buy 5 or 6 of them and see what shakes out. It's almost like a little miniature mutual fund, if you will, of multiple different cryptocurrencies, because I don't know if Bitcoin is going to maintain and stay the favorite, or depending on what Elon Musk tweets, Dogecoin is going to go up and down very volatilely. So it's hard for me to predict. So I'm not going to spend the time to research and figure out whether Ethereum or any of the other ones are going to stick or continue to grow. So I just picked a handful and invested in a bunch, just like buying a mutual fund. I don't have time to do fundamental analysis of 500 different stocks, so might as well just buy the S&P 500 index and let the index do what it's supposed to do. And by just the nature of companies growing and contracting, that list of 500 will change. The rankings within the 500 and just the companies that are actually on the list will change. Some will fall off altogether. Some will go down over time, right? Ford Motor was near the top 80, 90 years ago. Now it isn't. Still a viable company to own and invest in, but it's not near the top like your Apple or your Google or your Microsoft. Okay. The fourth one is precious metals. So you might not have a particular inclination to any of these, but some of you might, whether it's gold or silver. It's kind of the old version of Bitcoin nowadays. And there's a lot of debate and a lot of argument over what's a more viable investment. But I don't see it as a bad thing to diversify amongst multiple asset classes and just let the chips fall where they may, because I don't know what's going to happen in 20 years, whether gold's going to make a comeback or that's going to be the only alternative source of asset to hold your money other than cash. I don't know. So I might as well own some and then just hedge my bets and see where it goes. Now you can invest in just the actual source, gold in this case, or silver or palladium or platinum, but you can also invest in companies that do the refining and the mining and the distribution of those metals. So there's multiple options. You can invest in the actual physical gold coins or gold bricks and hold them, obviously in a safe or a safe deposit box or something. Or you can just invest in funds that buy those gold bullion or silver coins and hold them for you. Some options there. So with options 2, 3, and 4, individual stocks, cryptocurrency, or precious metals, I would say that you want to have them as a complement to your overall investment strategy, meaning that I wouldn't invest more than 10% of all of my investments in any one of those individual buckets. So if it were me, what I'd consider is, once my savings rate got to that 10 or 15% threshold, going to my traditional, what you'd call traditional investments, 401k, Roth IRA, traditional IRA, whatever, then I'm going to supplement it with maybe some money set aside into a separate savings account so I can build my investment real estate portfolio. For now, it's just going to be going in cash till I have enough for a down payment, right? I might consider a portion of that into individual stocks, and then I might consider some more of that into a few different cryptocurrencies. So let's say I have $1,000 a month maybe not even that much. Let's say you have $500 a month that you can save. And this is in addition to well, let's just use it as the whole thing. So $500 a month that you can save somewhere. 70% goes into your 401k, IRA, traditional IRA, Roth IRA, whatever it might be. Okay. So $350 goes there every month. $50 goes into your investment real estate bucket. $50 goes into your individual stocks. Let's say you want to buy Tesla and Google. And then the third one maybe buys some Bitcoin and Dogecoin, $50 there. So that way you're spread enough, but you're not overweight in any one of those particular individual stocks or cryptocurrency. So that if the cryptocurrency market completely takes a dive and your $50 is all of a sudden zero, it is only 10% of your overall net worth. That's the whole point, because these are more centered and concentrated positions and holdings and investments. I don't want to see you have more than 10% in any one of those buckets. Now, as you grow your investment real estate portfolio, it will eventually be worth more than 10% of your overall buckets. To me, that's okay, because you're buying assets that perform, that produce cash flow, but particularly with, again, numbers 2, 3, and 4, individual stocks, cryptocurrency, and precious metals, I wouldn't have more than 10% in each of those buckets. So 30% or less of your overall wealth in those three. Cool. Okay. So again, in general, that is all I have right now. So again, the 4 alternative investments: investment real estate. I went through a few different, 5 or 6, 7 different options and examples of that. Individual stocks, cryptocurrency, and precious metals. Again, with the last 3, keeping that 10% or less in each of those 3. So 30% or less of your wealth and of your savings monthly going to those, with the remaining 70% could be split some combination of investment real estate and then your just traditional 401k, Roth IRA, traditional IRA in, again, broad, diversified index mutual funds, total market mutual fund, target date retirement funds, something along those lines. Okay. That is all I have for you today. I think that's everything. If all of this is kind of confusing and up in the air and you want to clarify and hone in on your exact investment strategy and to know if you're actually ready to begin, schedule a 30-minute strategy session with me. I'll walk through all this with you. ignitingfinancialfreedom.com/coaching. For the quick win, go to Bigger Pockets. They are a wealth of knowledge. They have a massive forum. Thousands of different real estate investors collect there. They've got 4 different podcasts that I've been listening to for, my goodness, at least 5 years, maybe longer. They have a real estate rookie podcast, which is great for the beginners. They have their original Bigger Pockets podcast, which is now a bit more advanced in terms of their real estate strategies that they discuss. They've also got a business related podcast, and they've got a money related podcast, which would be a lot more like what you're listening to now. So definitely check that one out too. They've got books that they write on how to rehab houses, how to buy, how to do a BRRRR strategy, the one I mentioned before, how to do a flip strategy. So they've got a lot of resources there, and the books are inexpensive and great value. So that is it for me. Stay tuned. I will have additional episodes coming up. I'm going to take on your biggest questions related to money. Again, if you have any questions that are maybe just not related to these types of investments, of where else should you invest, but anything personal finance related, again, book your strategies call. That is complimentary. That's a 30-minute call for me and you to sit down privately on Zoom. ignitingfinancialfreedom.com/coaching. I will catch you soon. That is all from me. All right, people. I'll see you later.